Hope you're easing into June all right. This week was packed, especially around jobs numbers, and there's a lot of noise to cut through. Let's start with the jobs report from the BLS that we got today. On paper, it looked like a strong number, but if you look under the hood, it's kind of a mess, and it's why I suggested clients lock before we got such an unreliable report. BLS said we added a bunch of jobs in May, but that really conflicts with just about every other report we've seen. ADP, which doesn't even count government jobs, only showed 37,000 private jobs added. But the BLS actually showed a loss in government jobs, so how could it be over 100,000 higher than an ADP report? Like I said, it wasn't a shocker. The BLS's own revisions have showed they overstated jobs by 219,000 jobs, and that's just from January to April. And the QCEW, which is even more accurate, showed an overstatement of over 550,000 non-seasonally adjusted jobs. Basically, long story short, this report's going to likely get revised again, but it won't matter by the time it is. The market doesn't pay attention to those adjustments. If you're wondering where those jobs came from, it was mostly healthcare, hospitality, and social assistance, which isn't bad, but those areas aren't really tied to overall economic strength. Most of those jobs are needed, and nothing the Fed does would change that. Unemployment did stay flat, but the details were telling. The separate household survey showed we actually lost 696,000 jobs, almost all full-time jobs, but 625,000 people left the labor force, which helped unemployment number look unchanged. It could have ticked up just based on rounding if it was just a touch higher. And keep in mind, trouble in the labor market could help mortgage rates and even cause the Fed to make a move, although their main focus is inflation right now. We saw wages up a little bit, not exactly what the Fed wants to see since they're watching wage growth as a sign of inflation. But also this week, Fed Governor Michelle Bowman gave a speech that wasn't necessarily exciting, but it could really matter. She was talking about changing a rule that's been keeping banks from lending more, even when they're holding super safe assets like U.S. Treasuries, and that change could lead to more lending. But it might also hurt the 10-year Treasury, which would help mortgage rates. And outside of that, we saw more signs of economic cooling. A report from Challenger showed job cuts way up compared to last year, likely partially related to those Doge cuts we saw. But initial and continuing unemployment claims are rising, and the Fed's Beige Book showed slower growth and rising costs. And in case you needed another reason not to, blindly trust those BLS numbers, they admitted this week that they're using a lot more guesswork, especially on prices and unemployment. Basically, the price checks that feed into the inflation numbers, the only job requirement to gather that information is to be at least 16 years old and have a driver's license. And with staffing cuts, they're just not keeping up. Even tiny differences like a 0.1% could make a huge difference in rounding that could swing markets. And next week, we're going to get CPI and PPI, two major inflation reports. And if they come in lower, we could see some rate sheet improvement. I'll keep you posted. Have a great weekend.